There's a big difference between what's shown on social media and what's happening in reality. We always have to sensationalize everything. We have to say how everything will be crashing by 95%, how we're going to make the 10x returns. But really, what matters is just, are things currently cheap? Or are they expensive? We can't be too deterministic about our investments. We can't sell everything. We can't go all in. It's all about portfolio weightings. And while this is not a sexy topic, while this is not necessarily something that sells the clicks, it is reality. It is how we should navigate the space. I think it's best to use quantitative approaches, to use mathematical models that used to work relatively well to describe how high or low something is. For example, over here, this is one approach. We are looking at Bitcoin on a logarithmic chart. So every horizontal line here represents a 10x return. And there's a trend channel drawn over here when Bitcoin might be expensive or when it might be cheap. And instead of trying to sell the exact top and buy the exact bottom, we can simply just sell as we go closer and closer to the red line, and we can buy as we get closer and closer to the purple line. So fundamentally, this is really the approach we should take for any asset class. We should try to figure some way to value that asset class. For stocks, this could be the PE ratio. For rental property, this could be the rental yield. For crypto, it could be a trading range. For gold, it could be its market cap relative to, say, the US money supply. So you always have different kinds of approaches to value different things. That's also why we don't have 100% correlation across the different asset classes, because the risks that we take on with any asset class are different to one another. They don't necessarily move in the same direction at the same time. And then if we want to get outperformance, it's all about refining the models. For example, this model is probably not the best because it did not turn a clear selling signal in 2021. Right? We had max bubble 2x above the current price. Currently, the possibly highest price would be close to $1 million. That's very far away from reality, right? At $1 million, Bitcoin would almost flip the gold market cap. There's an adjusted version of that model. This gives a slightly better maximum price at $418,000. But still, it would indicate that we're now very close to the potential bottom. And we've already seen how the model failed to predict the bottom. It said we could only fall down to 23K, yet we hit the 16K. So there's a good chance that 81K that the model now predicts is not the bottom. And so probably this is the best of the adjustments, because here we do see the tops align somewhat. We still didn't hit the top perfectly in 2021, but at least it's a better approximation compared to what we've seen with the other models. The bottoms, they align the best. Now, where is the Bitcoin bottom with that model? It's currently at 50K. And I think, not just based on this model, but based on many other approaches as well, that at around 60 or 50K, it's a good time to consider buying again. Again, we do not want to be too deterministic about anything. We simply want to adjust our portfolio weighting. We potentially want to have above average allocation when we are below the average cost basis in Bitcoin, right? When the current price is below what the average investor in Bitcoin has paid for the asset, that's a good time to buy. That's when the market is really depressed. That's at the end of 2018, the capitulation of the miners. That's during COVID. That's also after Terra Luna and FTX. Currently, that price level is at $56,000. Again, giving us a very similar potential bottom to the power law chart over here. Because that's a fundamental problem with more modern investments. In the old days, we had cash flows and we could simply just value an asset based on the cash flows, right? We've got property. We know how much it will cash flow, how much rental income we get. When we had good old stocks, we also tended to get dividend payments. But modern investments tend to not have that. There are plenty of successful technology companies that have never ever paid a dividend, that have never really shared their profit with the shareholders. They're just building up the potential to pay out dividends. The same is true for Bitcoin, right? For Bitcoin, we also don't have any real cash flow. We just insure ourselves against a potential financial collapse, against a potential transition from traditional finance into something that might be more decentralized. And so we have to use other metrics, right? For gold, for example, we can just compare the gold market cap to the monetary base. Here we've got the gold price relative to the monetary base, not the gold market cap. Unfortunately, gold does have inflation as well, right? It expands by roughly 2% per annum. And so we might actually expect that over time, gold will underperform a constant monetary base. So I do think that gold is currently quite expensive, unfortunately. It's also above its historical average ratio by roughly 70%. And so here's what I use for Bitcoin. I look at the psychological anchor point of the market. If currently a lot of people are in profit, then they might take that profit. If a lot of people are currently in losses, they might just keep on holding. If, of course, the long-term story of Bitcoin continues to stay sound. Here is the net unrealized profit and loss. And only when the average Bitcoin investor is in net unrealized losses, when they see on average red in their portfolio, that's the best time to buy. We are not there yet, unfortunately. It seems like the severity of the unrealized losses tends to decline over time, so bear markets aren't as bad anymore as they used to be. Still, we might very much hit the zero line, potentially fall below that with the current bear market. The long-term momentum tends to decline as well. So there's an indicator called the relative strength index, and that measures how quickly is an asset moving relative to its recent average. If this is moving very quickly to the upside, then the RSI is high. When this is crashing, this is going down, then the RSI is low. And so over the years, we see Bitcoin's monthly RSI going from one extreme to the next, but we also see that the tops tend to decline over time, as do the bottoms. In other words, there is a long-term drift towards worse price performance over time. Again, we are not yet at any bottom here. I don't really like doing it, but that's how the YouTube game works. That's how the algorithm works. Please give this video a like if what you've seen so far has been useful. Thank you very much. Have a look at the thermocap multiple. So this is a minus indicator. How much issuance of Bitcoin do we have relative to its outstanding supply? That also tends to have a tighter and tighter trading range. We are just in the middle of that range. And so what tends to happen is that the people that took most risk, they get wiped out first. Then the people that have just medium risk positions, they lose their money afterwards. And then only at the very end, the long-term holders get in losses. The overall market is in losses. You might remember October 10th. That's when we saw a flash crash in the market, right? Most altcoins on that day fell by more than 50% within a few hours. Then that partially recovered. But that is when all the levered traders, all the perpetual futures traders, they got wiped out. At least the ones that were betting on rising prices. But now we also start to see how the short-term holders tend to accumulate more and more losses. This tends to happen in a bear market. The short-term holders, they tend to just get more and more into the losses. They never really recoup their losses. Have a look at the short-term holder cost basis. Here is 2018. The price tended to be below that cost basis pretty much during the entire bear market. Whenever short-term holders got close to the average cost basis, they then very quickly exited and waited for better times. We had the exact same development in 2022. The price tended to just be below the short-term holder cost basis. And once the short-term holders were somewhat break even, that's when they sold again. And currently, we are just entering exactly the same development again. The short-term holder cost basis is currently at $104,000. And it is declining by the day. Now, everybody wants prices to go up. So why do we see the opposite, right? Why do we sometimes see those bear markets? If everybody wants prices to increase, what triggers actually the downward pressure? It's usually people taking profit. People that tended to hold the asset for a long time, that just rode the bull market, and that then, after making multiple X returns, they then realize that profit and potentially move this into other asset classes or just use this for consumption. And we have seen this in Bitcoin, unfortunately. This is the CoinDays Destroyed 30-day moving average. It is extremely high. The raw numbers don't look that much better. And even on a 365-day moving average, we are very, very high. So in the last year, we have seen long-term holder profit taking that is unprecedented. We have only seen this in 2018 when Bitcoin did a 100x return, right? From $200 to $20,000. That's only when the long-term holders were incentivized to sell at a similar rate. But this time it took much less price appreciation because now the long-term holders see how the market has matured, how the upside for Bitcoin isn't as high anymore as it used to be. And that's really the fundamental problem. As a risk-on asset, Bitcoin isn't as attractive anymore as it used to be. The outperformance versus, say, the Nasdaq 100 is pretty much non-existent. And that then requires timing the market. That then requires to only buy when we are below the realized price. Here, have a look at the Bitcoin price relative to a Nasdaq 100 ETF QQQ. Of course, in the very early days, Bitcoin outperformed technology stocks very nicely by tens and hundreds of thousands of percent. But since 2018, so this is when Bitcoin hit $20,000, the outperformance versus other risk-on assets has declined massively. Right? This rally, right, when Bitcoin hit $60,000, during that time frame of 4 years, we only saw 57% outperformance. Yes, we did have our massive volatility of drops of more than 80%. So the question is, do you like this kind of volatility or do you not like that volatility? If you time the market, then of course drops like this are great because that's a potential opportunity. But if you're just a buy and hold investor and you look at long-term performance relative to risk, then you don't like those kind of drops. So that's the difference between speculating and just allocating towards a portfolio. If we speculate, if we time the market to a degree, volatility is great. But the speculators are only a small fraction of the overall investment space. And that's a problem. There's only that much growth in that segment. And so we can spin this even further, right? Bitcoin from 60K to the current price even underperformed the Nasdaq 100. So we've got underperformance plus more volatility. Bitcoin was a worse investment compared to tech stocks over the last 4 to 5 years. And so this opens up the big question, right? Is Bitcoin really the best asset to dollar cost average in? We could draw an analogy. We could talk about, say, altcoins, right? Altcoins have the same kind of pattern. Altcoins tend to have more volatility than Bitcoin, but they also tend to underperform long term. Thus, it makes sense to dollar cost average into Bitcoin over just a random altcoin. Now, if we see this chart, we might draw the same conclusion. Maybe the Nasdaq 100 is a better vehicle to dollar cost average in compared to Bitcoin. Really, if we just drop a little bit further, if we get close to the realized price, then we can draw the conclusion that over the last 8 years, Bitcoin has not outperformed a broadly diversified portfolio of technology stocks. And I'm not even talking about just buying the winners within technology. I'm not comparing Bitcoin to Nvidia or to Amazon or to Google. Then the picture would look even worse. I am comparing this to the risk of well-diversified option of investing into tech. And I really think it is this chart, this consideration of risk to reward long term, that makes the long-term holder sell. Of course, there's also a story about the 4-year cycle, how the next year might not be as profitable as the last one because we've seen a nice bull market. Yes, there is a story as well, and this might become a self-fulfilling prophecy. But besides that, the risk to reward for crypto and even for Bitcoin hasn't really been that great. People sell Bitcoin because it doesn't return anymore what it used to return, especially compared to the alternatives. That's why we are seeing historical selling pressure by the long-term holders. And that's probably also why this bull market has been much more muted compared to prior bull markets, why we didn't really see anything heat up, why we didn't see the retail investors coming back, the altcoin season coming back. All of those things tend to only happen if the Bitcoin price appreciates quickly enough. But if at the same time we've got the long-term holders offloading all of their cheap BTC, then the bull market can't really unfold and we can't really see a blow off top. And we're just fizzling out and enter a bear market due to apathy, not due to short-term hyped prices. Have a look at the hodl waves. How much of Bitcoin has been held for how long? So it's just 100% of Bitcoin supply. So it's normalized because, of course, Bitcoin supply is not constant over time. But we can take away the longer term holdings. We just look at the Bitcoin that has been held for a maximum of 2 years. And this tended to go up during a bull run, right? This is when the short-term traders come in, when media talks about crypto, when everybody gets excited. That's when new investors come in, when the short-term holders enter the space. This is now all the Bitcoin that has been held for a maximum of 1 year. And we now see this going up again, even though the Bitcoin price hasn't hit any new all-time highs. And that's just a reflection of the long-term holders offloading. So once we turn the chart around, once we look at the long-term holders, we see how this is constantly declining. The long-term holders dump on everybody. And unfortunately, they dump at a rate that's too fast for any excitement to build up or even to just outperform other risk-on assets. It's like the insiders of an altcoin dumping on the following and creating the long-term altcoin underperformance. This time, it's the early adopters of Bitcoin that now dump on the community at a rate that exceeds Bitcoin adoption, that exceeds new people coming into the space. Profit taking is fine, but profit taking that's quicker than adoption is a problem. And so this cycle might just turn around a bit earlier compared to prior cycles. We had 1 bearish year, 3 bullish years, another bearish year, 3 bullish years, then another bearish year, and this time the last year, year number 3, isn't bullish. We are already turning around now. Have a look at the performance since the cycle low. Our current cycle is the red one. We have peaked at similar points in time in the past. And so we might just see history repeat itself again. That's at least my base case. The horizontal lines here, that's the day of the halving. The green area is up until so many days after the halving. So 40.95%. Every 4 years, we tend to see the halving. We can see that after those 40.95%, we tended to see the price coming down. Not in the very first cycle, but definitely since the cycle that started in 2012. If 2026 is a bearish year, we'd simply just see history repeat itself again. The pattern would just be repeating again. Now, this whole game can be as complex or as simple as we want. We can just dollar cost average into the market, just bet on long-term adoption, bet on long-term devaluation of money, and we are fine. We don't necessarily have to time the market. Alternatively, we can make it very complex, as in we try to follow every single piece of news. We try to get an edge by being more informed than the average market participant. I think the best is a middle ground. Trying to still time the market, but not just based on guesswork, based on mathematical approaches that used to work pretty well in the past. And so this is my favorite approach. It's following a technical indicator, the moving average, that historically worked the best. What we see over here, that's the 44-day simple moving average. And the strategy is very straightforward. We go long, we bet on rising prices whenever we are above that moving average, and we bet on falling prices whenever we are below that moving average. Now, I've backtested all moving averages from the 2-day to the 200-day, and the 44-day is one of the best. And historically, this worked very well. Will it work in the future? Who knows? But at least over the last 10 years, it performed much better compared to just buying and holding. Buying and holding is the line here in white. Every horizontal line here, by the way, that's a 10x return. So this performance is more than 100x better than just buying and holding Bitcoin. Here's the same performance measured in BTC. And so that's then the potential alternative to just dollar cost averaging into Bitcoin, trying to ride the market. Now you can simply trade this yourself, right? You can just buy and sell whenever you're above or below the 44-day simple moving average. Or if you wanted to, you can also allocate towards that strategy directly. So that's part of the premium membership of this channel. The link is down below. It's thebitcoinstrader.com. A link to premium pops up here on the screen. It will lead you to the website. Thanks again for watching and see you next time. Cheers.